Hey everyone. So, if you're sitting in high school right now, or maybe you're just starting to earn your very own cash, you probably think investing is, well, something only older people in fancy suits do, right? But here's the absolute truth. If you're just letting your money sit idle, you're literally losing the game before you even hit start. Today, we're diving into an explainer of some eye-opening source material that shows you how to stop letting your money sit AFK, away from keyboard, and actually start playing the investing game to win. We're going to break down exactly why you need to invest, how the mechanics actually work, and the exact practical steps to get your money working for you. To kick things off, let's look at why your standard bank account is essentially a trap. A lot of us think saving our cash in a massive big bank like a Chase or a Wells Fargo is the absolute safest, smartest move you can make. But here's the kicker. Those savings accounts pay an incredibly low interest rate. We're talking sometimes as low as 0.01%. To put that into perspective for you, if someone hypothetically handed you a massive $1 million and you parked it in one of those accounts, at the end of the entire year, you'd have earned a pathetic $100. That's it. Your money is completely AFK. It's just sitting there, not working for you at all. All right, let's jump straight into level 1, the invisible money thief.
Okay, let's dive into this because this is absolutely crucial. If your money isn't growing, it's actually dying. Think of inflation as a nasty status effect in a game that slowly but constantly drains your purchasing power health bar. Over time, the cash you've got stashed under your mattress actually buys less and less stuff. And if you really want to see inflation in action, you literally don't need to look any further than the Postal Service. Back in 1971, buying a standard stamp to mail a letter cost just 8 cents. As of the time of our source data, that exact same stamp costs 63 cents. The mechanics haven't changed at all, right? The stamp still does the exact same thing. It gets your letter delivered anywhere in the US. But because time has passed, the cost has skyrocketed strictly due to inflation.
Now, the Federal Reserve, which is the central bank of the U.S., actually targets a 2% inflation rate every year, just to keep the economy healthy. But recently, we've seen inflation hit anywhere between 6 to 8%. What does that mean for you? Well, it means the cost of your favorite fast food combo meal just keeps ticking up and up. And if your money isn't earning at least 6 to 8% a year to match that, it is actively losing value. It's literally losing its power while just sitting there in your checking account. You absolutely have to invest just to keep your head above water. Which brings us to level 2, the compound interest cheat code. So now that we know our enemy, let's look at our primary weapon. Compound interest is basically when the interest you earn starts earning its own interest. In gaming terms, it's exactly like your past XP generating new XP entirely on its own. So the crucial point is, look at how this math stacks up. Let's say you invest $1,000 and get a 10% return. At the end of year 1, you have $1,100. Awesome, right? But in year 2, you don't just earn 10% on your original $1,000. You actually earn 10% on the $1,100. So you end year 2 with $1,210. Fast forward 20 years. By simply letting this exact pattern repeat, your original $1,000 levels up to over $6,700. You didn't do any extra work. Your money just started earning its own money. Next up, level 3. Choosing your player build. When you actually enter the market to get those sweet compound gains, you have to choose your player build. You've basically got the active path or the passive path. The active path is day trading individual stocks, like taking your hard-earned cash and dropping it into just Tesla or just Coca-Cola. It's high risk, it's incredibly stressful, and it requires you to monitor the market literally minute by minute. It's a super sweaty way to play. For example, if you picked an individual tech stock like Intel during the dot-com bubble back in the year 2000, your investment still wouldn't have recovered its all-time highs today. No way. The passive path, however, it's completely overpowered. You buy a massive bundle of stocks, diversify your risk, and you check your account maybe once a year while staying totally chill. Now, to play passively, beginners often look at funds. A mutual fund is basically a giant pool of money run by a professional manager. But here's the catch. And it's a big one. That manager has a mortgage to pay and kids to feed, so they charge you incredibly high fees for their so-called expertise. On the flip side, an index fund is completely automated. It passively tracks a giant list of companies, like the S&P 500, which is just the top 500 companies in the US. Because there's no expensive manager to pay, the fees are practically zero. Now, what's really interesting about this slide is how Instantly diversified you become. By purchasing just one single index fund that tracks the S&P 500, your money is automatically split into fractional pieces of the 500 biggest companies in America. You instantly own a tiny sliver of Apple, Microsoft, Amazon, Google, and hundreds more, all at the exact same time. It's brilliant. If one company has a terrible day, the other 499 are right there to hold up your portfolio.
And guys, the historical stats on the S&P 500 are just incredible. It typically returns between 8 to 10% a year over the long run. Let me put that into perspective for you. If you had taken just a mere $100 of your hard-earned money back in 1980 and invested it into the S&P 500, it would be worth nearly $10,000 today, $9,977 to be exact. Even when you adjust that for inflation, your money would have multiplied in value about 27 times.
All right, before we hit start, we need to go through level 4, the pregame checklist. Look, I know seeing those massive numbers makes you want to smash the buy button right this second, but hold on. There are strict prerequisites you absolutely must complete before you hit start on your investing journey. If you skip these, you risk getting completely wiped out. First things first, pay off any high-interest debt. We're talking anything over 10%. Paying that off is literally a guaranteed 10% return on your money. Second, save 3 to 6 months of living expenses in an emergency fund. That's untouchable cash that just gives you peace of mind. Third, never invest money you might need for a short-term goal, like buying a car next year. Only invest what you can afford to leave alone. And lastly, you need a consistent income. Seriously, if you only have $100 to your name right now, don't put it in the stock market. Invest that $100 into yourself to learn a new skill and generate consistent income first.
Okay, checklist complete. Welcome to level 5, hitting start. So assuming your checklist is good to go, we are going to demystify where and how you actually play the game. You essentially have 2 main options here. The first is a retirement account, like a 401k through an employer or an IRA. These are fantastic because they give you massive tax advantages, tax buffs, if you will. The trade-off, though, is your money is largely locked away until you reach a high level, aka old age. If you want more flexibility, you open a standard brokerage account using an app like Fidelity, Charles Schwab, or Robinhood. You know, in the old days, you actually had to call a guy on a telephone, kind of like Leonardo DiCaprio in The Wolf of Wall Street. Today, you just download an app. And this brilliantly illustrates just how easy it's become. Buying a piece of the S&P 500 takes literally 3 simple taps on your smartphone. Step 1, you search for the index fund's ticker symbol. Think of a ticker symbol kind of like an airport code, but for stock. An S&P 500 fund might use a ticker like VOO. Step 2, instead of trying to afford one full share, which could cost you hundreds of dollars, you just choose to buy in dollars and type in your $100 to buy a fractional share. And step 3, you just place a market order. Just to clarify that last step really quick, a market order simply tells the app, hey, buy this for me as soon as possible at whatever the current price is. There are definitely more complex options out there, like limit orders where you wait for a specific price to hit, but honestly, for a beginner looking to get into a long-term passive index fund, a market order is absolutely the simplest, fastest way to get your money into the game right away. So here we are at the end game. You know the rules, you know the cheat codes, and you know exactly how to build an overpowered passive portfolio. Remember, your greatest advantage right now is your age. The earlier you start letting compound interest do its thing, the more massive your wealth can grow. But you've got to remember that invisible thief, inflation, is actively draining your money's power while you just sit on the sidelines. So I'll leave you with this provocative question to really think about. Knowing everything you know now, what exactly are you going to do with your next paycheck?